curious thing up. Our next guest is in the camp that the banking crisis is not over and could have severe economic implications. Jim Bianco is president of Bianco Research. Jim, great to have you with us. We were just talking about First Republic, and I know you retweeted something, and I thought this was very interesting. And for those of you looking for a high interest rate deposit, listen up. First Republic, along with a lot of these other, banks that might have seen deposit flight, are now offering very high rates to attract deposits, which tells me that maybe they are still seeing flight. They still need to replace the deposits that had left. When you're talking about 4.95% on a liquid 7-month CD, that ain't bad. And that's what First Republic is offering. What does that tell you?
Well, it tells me what you just said, that they are probably still having a deposit flight problem. But the bigger picture of what's been happening is the deposit outflows from all these banks, it really picked up starting around Thanksgiving when rates went above 4%. We're in a new world now. We have mobile phones. We have 120 million mobile banking apps. It's not hard for you to pick up your phone, transfer your savings from a zero-yielding account to a 4.5 or 4.75 money market account. It's the rational thing to do. We should expect that when the H8 report, which shows banking numbers, come out week after week after week, that we will see deposit outflows. Why would people automatically say, I want to watch Fast Money because I want stock tips, but I got $250,000 in a zero-yielding bank account. I'm not going to spend 3 minutes on my phone to rectify that situation by going to a 4.5% money market yield. And as those deposits keep coming out, eventually these banks are going to be impaired on their ability to continue to lend, and that could hurt the economy.
So basically, even if deposits go up or seem to stabilize, at the drop of a hat, they can leave just as quickly as they left during this banking crisis. And so there really is no, in your view, is there a safety period where we can say, oh, that was over? Because it seems like you can't really put up gates on the world of mobile banking and prevent this from happening again.
You don't want to put up gates. That would be the wrong answer to do, is to put restrictions on your money or my money. Really, once the banks start offering deposit rates that are competitive with market rates, then you would say there's no reason for me to reach into my pocket, pick up my phone, and move my money. And then things would stabilize. But other than Pacific West, First Republic, and a couple of other banks that have been in the news that have raised their deposit rates quite a bit, the vast majority of banks are still offering deposit rates down around 0.5%, if not with the big money center banks down somewhere near zero. So they're not offering anybody any kind of incentive to stay other than a safety incentive. And once they've reset their password, they're going to start looking elsewhere. And a lot of them have in the last month.
Hey, Jim, it's Tim. So a lot of what you're talking about now, but certainly the things that have built in this conversation are about bond market volatility. Guy talks about it all the time. You've talked about it all the time. I think we all do. A 3% 2-year to me is a 3,500 S&P. And I'm just curious your view on the moves we've seen over the last couple of days when we finally gotten kind of that devastating economic data that I think has probably got more behind it.
Yeah, you're right. Whether rates go up or down is not nearly bullish or bearish for stocks. It's why. If we're going to get a 3% 2-year note because the economy is falling apart or is having a problem, that is not good news, because typically the worst time to own the stock market is when the Fed starts cutting rates, because then they admit that there's a problem. They're trying to stop a recession. They're usually too late, and they can't. Now, they're not cutting rates now. They're still talking about raising rates. But if we ever got to that position, it would be problematic. Bond market volatility is still very, very high right now. It's the opposite. I've heard you guys talking about the 19 VIX. The MOVE index, which is the version of the VIX in the bond market, is at 147, which is almost a 2 standard deviation high. That's inside talk for it's very high. And it is suggesting that the bond market is still somewhat unsure about what's going on and very chaotic, unlike what you're seeing in the stock market.
Jim, on a very first level, I read your notes. Technology has rallied because rates have gone lower. That's just sort of a knee-jerk reaction. But at a certain point, people wake up to the understanding that, wait a second, credit's going to be tighter. They are cyclical, and they're not going to be able to get access to capital the way they used to. So what is your sense about technology here?
Yeah, that's it. That, technology, to use a fancy term, is a long-duration asset, meaning they're going to earn a lot of money in the future, not a lot of money now. But when rates go up, then that future money's worth less. When rates go down, that future money's worth more. That's why they've been rallying, because rates have been going down. But if they're, again, why are rates going down? If they're going down because the economy's slowing, technology also needs people to buy their products. And if they're not going to be buying their products or doing with less of their products because of a slowdown in the economy, they're going to have problems as well. So the knee jerk, you're right, is that lower rates, good for technology. But why are we having those lower rates? That could wind up becoming a negative for it, too.
Jim, always great to get your thoughts. Thank you.
Thank you.
Jim Bianco, Bianco Research. What do you think here?